Hello, welcome to the first order flow explained video. We will be starting this series with an explanation of footprint charts, what they are, how they work, and a few things you can look out for yourself when using them to help you start being able to read them more clearly. In the description there are timestamps, so feel free to skip around if you want to, or if you want to go back and take notes, whatever you would like to do. One more thing before we start, I use ATAS as my trading platform. I'm not sponsored by them, I'm just being honest with who I use. I find their system to be reliable and intuitive, simple to use, and it provides everything you need for order flow trading. So if you want to try ATAS, there is a link in the description and you can give them a go. Also, as a bonus, you get a free crypto license with them for life if you want to trade crypto through the ATAS platform. With that said, let's get started. Let's begin with what even is a footprint chart. Well, I'm sure you're already familiar with a regular candlestick chart. On an up-closing candle, we have the open, the low, the high, and the close. And for a down-closing candle, we have the same, but the open and close, of course, are the opposite end of the candle. But that's all. Now, some will argue that the shape or size can also tell them what is happening, but in truth, they are still just relatively guessing. So how can you stop guessing? This is where a footprint chart, or a cluster chart as some call it, comes into play. It allows us to see how buyers and sellers are actually interacting. Think of it like this. A regular candlestick chart shows you what happened. A footprint chart can show you why it happened. Therefore, you don't need to make up a story of who is in control of the market. You can just see if it's buyers or sellers, if they are losing strength or not, and if you should be on their side right now or not. So now we know what it is, let's take a deeper look into what it all means. This is called a bid-ask footprint, and it is the most common footprint chart that you will see. And what does it show us? Well, as its name suggests, it shows us exactly that, the activity that happened on the bid and the activity that happened on the ask. In other words, the executed orders. This is unlike if you watch the DOM, the depth of market. Orders can get pulled at the last second, or new orders can come in and make you think that something different is happening. With the footprint chart, you cannot be spoofed. What you see on the footprint has actually happened. Now, let's fully understand the bid and the ask. I'm hoping this will be simple to understand, but pay attention. We will briefly begin with the depth of market so that you can better understand how a footprint is created. Note first what the DOM shows us, which is limit orders. So on the left side of our DOM, we have the bid. This represents the highest price that someone is willing to pay in order to buy a contract or share. On the right side, we have the ask or offer. This is the lowest price that someone is willing to sell their shares or their contract for. Simple so far, right? Another way to think of it is like this. Anyone waiting on the bid is waiting to be sold to because they want to buy. And anyone waiting on the ask is waiting for someone to come and buy off them because they want to sell. The next thing to note is we read diagonally like this. Our best bid is here at 1253.1 and our best offer is here at 1253.2. The spread is the difference between the best bid and the best offer, meaning here our spread would be 1 tick. Price cannot move without someone crossing the spread. If everyone sat with a limit order, the price would never change. It is aggressive market orders that move the market. We either need someone to hit the bid and sell to a buyer below the current lowest offer, or we need someone to raise the offer by paying a premium compared to the current bid price. This is how you get an instant fill when you trade with a market order, because you are taking a worse price in exchange for getting what you want, which is either to buy or sell in that instance. You will notice that if you were to buy at the market price and then sell immediately without the price moving, you would incur a loss of 1 tick in this example. This is because you would have bought at 1253.2 and sold at 1253.1. This highlights the importance of the bid-ask spread in your trading costs. So now onto our footprint chart. To the left, I've drawn what a regular candlestick would look like just for extra clarification for you. But let's focus on the details now. Firstly, remember this is not showing us the same information as the DOM. The DOM is showing us pending orders. This is showing us orders that have gone through and been executed. Meaning right here, for example, 10 contracts were sold to a buyer. We don't know if that's in one transaction or it could have been 10 single contract transactions, but whatever it is, we know for definite 10 contracts were sold here to a buyer. The left side of our footprint chart shows us market orders that hit the bid, meaning it is showing us the willingness of sellers at that price. In a simple way, think like this. We are tracking not how many people wanted to buy on the ask, but how many people were willing to actually sell to those buyers. Then on the right side, we are tracking the willingness of buyers to pay higher than the others are currently bidding. Therefore, they are crossing the spread and lifting the offer, taking the offer of a seller and buying from them. If you need to, just rewind and listen to that again to be sure you understand it, as it is a fundamental part of the footprint chart and actually all trading. So please make sure you understand it and feel free to ask any questions you have in the comments below. Now remember earlier I said we compare diagonally? Well, we still do that here on the footprint chart also. Alright, with this as our base, we can now understand how the other two common footprint charts are created. If we add across the bid volume and the ask volume at each level, we end up with this. What is this and what does it show us? Well, this is how a volume footprint chart is created, and this is how it looks in full view. The next thing we can do is take the ask, or the offer volume, and subtract the bid at each price level straight across. This gives us our delta. So ask minus bid equals delta. Delta is the difference between buying and selling pressure. Here is how a delta footprint chart looks. The volume and the delta I will cover in a separate video, along with setups that you can find on them. I just wanted to show you how they are created and their relation to the bid-ask footprint. Now back to our bid-ask footprint, and the next very easy thing to remember is this. The black box that I have here. You will notice that every candle has one. This shows us the point of control for this period. So on a 5-minute chart like this, where each candle is 5 minutes, this is the volume point of control for that 5-minute period. The point of control is the price level where the most volume traded, and it can be useful for us to see areas of support and resistance and to identify whether buyers or sellers might be in control. Next, looking here at our bid-ask footprint, you will notice that some numbers are coloured and others are not. The coloured numbers represent an imbalance. On the left side, the bid, we can see sell imbalances, and on the right side, the ask, we see buy-side imbalances. An imbalance occurs when the corresponding bid or offer is significantly larger. Let's take a look into one to fully understand what that means, as it's actually probably more simple than you're thinking. Remember earlier, we learned that we compare like this, diagonally. Okay, so all we're doing is comparing this bid volume to this ask volume. If one is significantly larger than the other, an imbalance will show. So let's understand what I mean by significantly larger. The term for this is actually called an imbalance ratio, which is very simple to understand. It just means how much bigger is one than the other. Here on this chart, I'm using an imbalance ratio of 150%. This means, for example here, our ask of 106 is more than 150% larger than the corresponding bid of 36. So it shows a buy imbalance. Likewise, at the top of this candle, the bid is more than 150% larger than its corresponding offer. Therefore, we have a sell imbalance. Just for reference, here is the same candle with 150% imbalance setting, a 200% setting, and a 300% setting also. As a general rule, the higher imbalance ratio you're using, the less imbalances will show up. Now, adding on to that, we have what's called a stacked imbalance, which is like this. This is where we have multiple imbalances over several price levels. They can act as great areas of support and resistance when price retraces to them, like in this example here. But wait, I know what you're thinking, and no, this is not going to be your holy grail to trading. Most likely not anyway, as although they are great, they are not always foolproof, and blindly following them is not really advisable. As you will see here in this example, price didn't fully retrace to the imbalance before continuing, and in this example, price failed to use it as support, and price ended up breaking down. So I'm not saying don't use them, but please don't run off and think that there is nothing else more to learn regarding trading footprint charts. They look great on the screen, but in my opinion, there are far better ways to trade and read footprint charts than solely using a stacked imbalance. The last thing I want us to look at on the bid-ask footprint is the finished and unfinished auction. A bullish move can only end once the last buyer has bought, meaning absolutely no one else wants to buy. And the opposite is true for a down move. A bearish move will only finish once no one else wants to sell it. We can see this by looking if the auction is finished or not. Here is an example of a finished auction at low of day. You can see that price was coming down, and at the low of day, marked by the red dotted line, we have 10 contracts traded on the bid and 0 on the ask. So the 0 is telling us that at this level, there was nobody else willing to passively sell. So why is this important to us? Well, especially at the high or low of day, it can offer us a great reversal trade. But stay tuned to the channel, because when we start looking at setups, I will explain it in more detail. It's actually one of my most used setups, and it offers a great return with very small risk, sometimes only 3 or 4 ticks. You will see in our example here, this confirmed the low of day, and the price did indeed reverse. Now, if we don't have a finished auction, then we have an unfinished auction. This occurs at the high or low of the session, but has trading on both the bid and the ask. An unfinished auction provides us with a good target for price to go to again, as it indicates that there is unfinished business at that level, and either the buyers are still willing or the sellers are still willing to take that price. It can serve as a target for a new trade, or if we already are in a trade, it can indicate to us that price isn't finished moving that way, and so we do not need to be trimming our position yet or closing out of the trade. I don't recommend you simply enter a trade just because you see an unfinished auction, however. It doesn't always mean that price will return to that level, or it certainly doesn't mean it's going to return to it straight away. But if you enter a trade and you can see a previous unfinished auction that price never made it back to, well, that's a pretty good target for your trade. Here is an example of that. Let's say we entered short on this retest of the stacked imbalance here. Our first target would be where? Well, I hope you're saying here at the unfinished auction. This could either have been your first scalp target, or you could have looked and seen that we are approaching the low of day and used that as your target. You can see when we reach low of day, we break it and leave another unfinished auction. Then we actually continue creating new lows on the day. I'm not saying I would have taken this and held short knowing we would have created new lows on the day. If I'm honest, I probably would have already been out at our first scalping target and maybe had a runner to be taken at the low of day. But what I want to show you is the importance of an unfinished auction, especially around the high or low of day. And I can guarantee you I would not have been looking for a long when I'm seeing sellers still interested in lows. Here is our last example. I just want to show you why you should be looking back to check for unfinished auctions. I apologize, this might be a little bit small on the screen, but I wanted to fit it all into one. Here you can see on the left we have an unfinished auction, and I've highlighted that level for you. Then later in the day we have 2 finished auctions that finished at the same level, highlighted here in the grey. Those who blindly thought This is the reversal level were stopped out by just a few ticks. We now have a finished auction above the previous unfinished auction, and price then reversed and went lower. As a little bonus for you, I just want to point out that here you can see a buy imbalance at this level, which indicates to us longs being trapped, along with some who are about to cry after being stopped out by just 1 or 2 ticks, only to see price continue in their direction. So that's our first understanding order flow video. I hope you were able to follow everything and understand the explanations. But what you need to do in order to really start understanding what I'm teaching you is you need to start watching the footprint chart and trying to understand what is happening based on the information it is showing you, not from a made-up narrative in your head. For example, are buyers in control? Can you see buy-side imbalances and an increasing delta, for example? Or is there just a lack of selling right now and prices just drifting with no real effort involved? Don't just look and say, oh, we will reach this level because there must be liquidity there. No. Start taking your trading seriously and the results will start to follow. Thanks for watching. I will see you next time.